So I'm going to start off by apologizing because I haven't done this in a couple of years. So maybe you might have seen my presentations that were taped and recorded. I've seen them online. But I didn't have a whole lot of time this year to update the slides too much from what are there. I did update my PowerPoint a little bit, but other than that, a lot of the content is the same. But what I've always done is kind of being more interactive a little, and it's your opportunity to kind of ask a lot of questions of me. I've seen and done a lot of things. I work with Deloitte and Touche here through kind of the first tech boom with PMC Sierra and MDSI and Pivotal Software, and was involved with several IPOs. I went down to Silicon Valley right during the internet bubble, worked with PwC on some pretty high-profile initial public offerings, kind of fell in love with technology through the whole thing. Joined a biotech company when the internet crashed, learned biotechnology, moved back to Canada in 2003, and then I've been running my own accounting practice, and what I do is provide contract CFO services, and have done that since 2003. In 2006, I got really involved with a client, Quick Mobile. Was a CFO for that company. Kind of day one, it was 3 people, and then soon it was 18, and last year it was 183, and the fastest growing software company in Canada. So love those stories. It's fantastic. I'm now working with more startups, and I'm really optimistic of what I'm seeing out there. Some great companies and a real appetite for financing. So what I'm going to go through is hopefully little nuggets of modeling your businesses, and also in the context of this competition as well. So let me dive in. First of all, how many people here, is this their first business that they've started? Excellent. How many are doing like technology startups? Okay, quite a few. That's a little bit of my forte, so if I'm bent a little that way, then just, and feel free to ask questions at any time as I go through it. So I'm really going to just talk about starting your own business and running your own business. I've done that quite extensively and work with hundreds of companies. Also, BC is a phenomenal place to start a business, and I'm going to tell you kind of here's the things you really need to know to capitalize on that. And then I'm going to move into kind of the traditional financial modeling. I did have a quick opportunity to look at Steven's presentation that's later. He goes into it a little bit different depth than myself, and I'm going to kind of leave that to him because he does a fantastic job of that from what I saw. And then I'm going to use a case study, which was my QC Docs software, where we submitted and raised a bunch of money and participated in this program many years ago, and I'll use that as a bit of a case study. So the first thing just to think about, and this is the context of New Ventures BC, first of all, starting a successful business is extremely challenging, especially a winner of a New Ventures BC competition is going to have certain criteria that might fall into a criteria of what a venture capitalist would look like. And the reality is, these statistics you probably already know, it's very hard to be that 1 in 100 that truly hits the home run, the Twitters, the Facebooks, etc. And so that's kind of the challenge of the competition. And also there's a little bit of a mentality too as you go through this process and as you're trying to raise money, that it's a little bit of a dragon's den out there, and you get a lot of criticisms of what you're doing. And I would encourage you to kind of ignore a little bit of that, take the words of wisdom, take it for what it is, but really focus on solving a problem. Clearly you're here because you think there's an opportunity. Clearly you're an entrepreneur. And I'll tell you, there's a whole lot of businesses that focus right in the middle and do extremely well. I've had 4 clients over the last 5 years that have exited. One went out to Twitter within like a year and a half of incorporation, which was phenomenal. Another engineering company that got bought by its first client. It's just like, hey, this is really working out. It was very lucrative to the 2 founders of that business. And so there's, especially in Vancouver, the appetite for getting a technology, getting it into a customer's a spectrum, and then kind of doing the Basil Peters early exit strategy, there's certainly money to be made. So I would encourage you just to focus in on that and solve a real problem. And there's lots of companies, not at the 1 in 100, but lots in the middle that will make a lot of money. Even QC Docs, we've repaid all of our investors, save too. And I'll tell you, that company allows me to, or that technology allows me to do a lot of amazing things from a services perspective. I'll also share this one because it's kind of disappeared back, certainly in the tech boom. NDAs, I've heard it now a bunch of times, like a real, like if I'm worried about telling you too much about my technology, I'll just share this one, which was kind of common knowledge, but I haven't heard it too much. If you're truly the best person to bring this idea and your technology to market, you shouldn't be too concerned about talking about it, right? As soon as you're reluctant to stand up and say, yeah, here's our idea, then that's kind of a first indicator to the investor that, okay, it might be a good idea, but if you aren't the right person to do it, then is it going to succeed? So I'll just throw that out because I've run into it a little bit in the last month or so. And this other one was really a new one, but especially with software companies, don't underestimate the value of services. I've dealt with a lot of investors and investment banks that are all focused around recurring revenue and licenses. But to get those businesses up and running and to truly see adoption, I'll tell you, services are critical to that success. Okay? So this is the BC tech model. I was a controller for a biotech company in Fremont, and I'll tell you the litany of bureaucracy of starting a company and managing payroll and all of the state and county sales taxes in the US is a little outrageous. In Canada, with Shred and the simplicity of everything that's set up, this is a great place to start a business. So a couple of rules. I don't know if you went to the legal one with Stephen Lucas, but he does a great presentation on this. From my perspective, I've seen a few bad situations where you start a business. There's usually a couple of founders, and ultimately if it unravels early on or even after a period of time, it can be really painful for the lawyers and the accountants to clean it up at the end of the day. So I really strongly encourage just a reverse vesting founder share round. Is everyone familiar with what I'm talking about when I say that? Any questions about that? So when you incorporate a business, it's the founders round's your opportunity, and I'll show it later in a little cap table, but that's the day you start the business. It's worth $1 effectively, right? So if you can get a group of people together there, you're capitalizing on the long-term value of your idea. Okay, so the problem is, as you build it, probably on day 2, the business is worth considerably more than $1, hopefully. And as the business progresses, the value continues to go up. Well, if somebody exits at some time, because you're for all intents and purposes partners, then you have a challenge of how do you redistribute that. So simple vesting allows that, okay, you've been given the shares, but it's relying on you continuing to provide services over 3-4 years, and this provides a really easy mechanism to unravel that problem. Question?
I've heard a lot about different vesting models.
Right.
And, in your opinion, past experience, what's the typical time frame for those for the initial founders? 3, maybe 4 people. And are they time? Is it based on time or milestones or a combination of both, depending on the roles?
I'm the accountant, so my preference is a little bit of simplicity as opposed to milestone driven. Definitely employee, and I don't see off the top why it would be much different from founders, but a 4-year, it's taking sometimes longer to bring, especially a business to full fruition than, it wasn't uncommon where it would be 3-year vests or shorter periods. So kind of the flavor of the day now is a 4-year vest with a 1-year cliff vest. Okay, so you pretty much got to stick it out for at least a year to get anything, and then from there on, clearly you've made a commitment to the business. That would apply to employee stock options as well. Okay, so that's definitely what I would recommend. Okay, this one's critically important. If you can't raise the first $200,000 or $25,000, and why is $25,000 important? There's no hints on this screen. Why is $25,000 important? Would it be important in British Columbia to raise $25,000? Come on, you guys must know this.
So they invest the tax credit?
Yes, yes.
Isn't it 30,000 on the 25?
No.
Oh, right. This 25?
Yeah, it's 25,000. So it'll be on the next screen, but yeah, this is a really important amount of money, because if you want me to invest in your company, and I've done it a few times, you better be able to get me my BC government tax credit, 25% of my money back, 30% of my money, maybe that's a 30% of your money back, okay? Great program in British Columbia. But you need to have put at least $25,000 into the company. So, and then the point of this one is, if you can't raise it from close friends and family, it's going to be harder to go and meet some of the local angels and convince them that they should put their money in as well.
Now, does that $25,000 have to be a one-time investment, or can that be built up over time?
It can be built up over time. Definitely makes it easier for the ministry to just go, yeah, you're good to go, if it's just one fell swoop. But yeah, it can definitely trickle in. Okay. This one's close to my heart, being an accountant. Expense reporting, okay? So that's the importance of separating yourself from this corporate entity. Who's incorporated here as opposed to running as a proprietorship or as a partnership? Most people have incorporated. Okay, as soon as you incorporate, you may still be running around putting everything on your personal credit card to get your points. However, you need to separate those expenses from this company's expenses. You've incurred them on behalf of the business, and what's coming off of every expense that's relevant to the business? GST. Okay, so that's the next important one. Okay, so once you start submitting these expense reports every month and you're capturing this, you're separating what's related to that business, and your personal stuff is your personal stuff. And then, I think it's almost second. Yeah, this one right here. Register for the GST like the day after you incorporate, because you're just going to get an invoice from your lawyer for about $1,200. It's going to have GST that you get back. Okay? So you're going to start your business. You're going to incur all these. You're going to go for coffees with all your friends and tell them how great your business is and want them to invest. You're going to get this little trickle of your GST back. But the Revenue Canada doesn't register that until you make a phone call into them and say, yeah, I want to be registered for GST. You'll go, oh, well, we're not making any money right now. Do we really need to bother with all that? Well, that GST adds up pretty quickly, frankly. And just file initially as an annual filer. So once a year, you get your lump sum check back for all of the coffees that you incurred, or your legal bills, or whatever else you're incurring. Okay? The next one is technology. So Shred is a phenomenal program. I'd say I must be up to about $20 million that have trickled into real pure startups over the years into my clients from this program. Hands down, it's been the biggest money raising, more than NRC IRAP, NSERC, and frankly investors. So it's a very lucrative program. And at its core, despite its complexity, is some real fundamental value, which is build some real technology, do something different, move the dial, do something that is hard. That's what people want to invest in, and ultimately, it will render the company more valuable. So pay attention to that program and capitalize on it fully. The proxy rule. What's the proxy rule? Is anyone familiar with that? Okay. A few people know.
They give you credit for overhead at a certain percentage of your R&D expenses.
Right. If you employ people, okay? So yes, the proxy kicks in if you actually start hiring people. You've incorporated the business, you're starting it. So should I spend money on a contractor to do this work, or should I hire an employee? Well, the SHRED program, it's ratcheted back a little. It's 55% overhead now, but it makes it very lucrative for you to employ people. And frankly, the complexity of the employment rules in Canada are quite straightforward and easy to comply with. And that program definitely outweighs the additional administration, and really the administration is minimal, of employing people. Okay? So I would encourage you to carefully understand that. Okay? Oh, there's our EBC. Okay, I explained that one already.
Oh, one question here.
Oh, sorry, yes.
I just have one question around SHRED, and that is, if you're doing your development through contract work, is that shreddable, or does it have to be T4able?
Good question. Yes, it's still shreddable, but you don't get the proxy. So say you hire a software engineer for $100,000. Well, the taxable spend becomes $155,000, which generates a 35% federal tax credit and a 10% and a 10% provincial tax credit. There's a little math in the middle there, but yeah, as opposed to a consultant, and they've just changed the rule this year, I think it goes down to 80%. So you paid $100,000 to a consultant before. You used to get that 40% effective tax credit would go on $100,000 as opposed to $155,000, as well as now they have a new rule which makes it even more of a disincentive. It's only 80% of the contractor, so $80,000 becomes eligible. Okay. NRC IRAP, call up RIS or any of the ITAs, develop relationships with them. They're fantastic. They're really smart business advisors, and they do one really amazing thing if you can get onto them, even through like a Y program, if you're hiring people under 30, is they kind of bona fide your SHRED work in advance. I don't think I've ever seen a client that has IRAP ever get a technical challenge from NRC. And it might be as simple as getting a $30,000 Y grant, because a component of what you're doing with NRC is submitting a technical innovation, and they will be asking many of the similar questions that come through with SHRED. So develop those relationships. They're good people. Strike telefilm out. It's not really doing anything other than, I think, in film and television now. It used to be active. That shows how old I'm here a little bit. NSERC's still a very active program. MyTax, all of these government programs are great. Okay, the next one is just get out to the angel circuits. There's really good programs out there. Is there a question coming?
No, sorry, you skipped number 6.
Oh, sorry, I had talked about that previously. That was if you want me to put $100,000 into your business, if you apply for that, when I file my T1 next year, I get $30,000 back from the Ministry of Finance, British Columbia government. So it's really, really a big incentive for investors to know that you have registered for that program. And they didn't sell out last year. It's shocking. Okay?
There's a limited pool?
There's a limited pool, so it's a race. Okay? And I don't know, I think it was like 25 million last year in credits. So you want to register. It resets every March 31st. It's take your executive summary that you finish with this and send it over with a 2-page write-up and why you're qualify under one of their categories, and get signed up. If you have a decent proposal, decent executive summary, you'll pretty much qualify, because they then rely on the actual investors to do the real due diligence on whether they're going to invest in you or not. Okay? And that's these guys, okay? So get out to the angel networks. There's some great programs. And start pitching your businesses. It's a terribly painful process, but like I said, just take it for what it is, and put a smile on your face, and don't worry that every criticism that you get is somebody trying to be a Dragon's Den entertainer. Just get out there and kind of an add-on to that is get in front of customers, right? Don't be afraid to go out to the people you're ultimately solving a problem for. A great example where a client was their first customer, was an engineering company, and bang, they got bought. It was a great idea, and it was off to the races. Okay? And they will ultimately help build their product, even if it's like services oriented, right? The worst, you could always go get a job, right? So if you have some expertise and you're building a product around something you have some expertise in, and you develop a relationship with a customer, and initially the work may be, let's help me service me to get me to help you build your business. Many businesses I've seen do exactly that. And there's such a hesitation to do that. I know it can kind of drain you from the focus of what you think their problem is. But I mean, I've seen far more examples where you try to build what you think is someone's problem, and then you go to market and it falls flat on its face. The ones that have done this, like Quick Mobile is a really fantastic example of doing that. Getting out and building something and then working from a services perspective to leverage that into an amazing product with some amazing customers. And that was just a really good example where I was just not afraid to go out and provide services, even though it's a software company, and then using those services to build a product around it. Okay? I think everyone's out here for this purpose here, which is to build partnerships and networks and get people giving you feedback about your ideas, etc. Yeah.
I know you're not a jury, but would you say that the service business has a chance to win this competition?
I hope so. There's some amazingly profitable services businesses out there, and I think many of them are woefully neglected by the traditional venture capitalists and bankers out there. I grew up with the PwCs and Deloitte's, and these are billion-dollar services businesses. There is a tremendous amount of money to be made there. The reality is they're not the Facebook, right, where there's just this huge engine of cash with kind of no effort. Like, that's what everyone's dream is. But I'll tell you, to fall in the middle, kind of my first story was, if you really want to have a successful business, don't be afraid to do services. You might end up getting down to that 1 in 100 type business. But yeah, I would hope that there is a little bit more appetite for services out there than there has been, I think, in the past, and certainly that you see with a lot of traditional VCs. It's just not quite what their model is, which is just massive multiples to their investment. Okay? So now on to finally what I was supposed to be talking about, but that's okay. I just kind of open it up a little on how to get yourselves successful out there. Okay, so the accounting hat goes on, okay? So the 5-pager that you've submitted had a component of financial statements that had to be submitted. Presumably it has the name of your company up there, unaudited, most likely prepared by management. It would be a 3 to 5 year projection, okay? You want to get the numbers out there certainly deep into your revenue so that somebody can have a good visibility. I've been working on a business model for a therapeutics business. That's like revenue in 2013 on an $85+ million spend, okay? But you got to build it that far out so you can see, okay, when the drug goes to market, what are people going to pay? What's the ultimate net present value of that? So you got to get it far enough out there to see a real meaningful revenue stream and profitability, presumably. Okay? So what's going to be there is a profit and loss, or it's called statement of operations. That's also followed closely by your balance sheet, it used to be called. It's now called a statement of financial position. It's got your assets, your liabilities, and your equity. And your third statement is your statement of cash flows. Okay? Okay, is there any? These are your very traditional financial statements. If somebody says, I want to see your financial statements, that's exactly what they're asking for. Okay? Your profit and loss is the picture over time. Okay? So add up your bank statement transactions from January to December, if that's a calendar year. The financial position is show me your balance sheet at December 31st. How much cash do you have? Okay? So one is kind of your picture of your performance over a period of time. The other one's just a snapshot today. How much money do you have? How much money do people owe you? How much do you owe other people? And how much of your investors kind of ponied up as equity in your business? Is kind of really fast, quick look at what your balance sheet is, okay? And ultimately your cash flow is just kind of makes everything balanced between how your cash got from, $100,000 last year to $1,000 today, and the sad story of what that might mean to your business. But anyway, next up is opportunity analysis, and I think Steve goes into a really good, if it's similar to last year, which is just an opportunity analysis. This one is huge from my perspective in terms of your starting point of your business. And my case study goes into it. But a really good example of, I think, a past New Ventures winner was a company that's developing software and a device for monitoring your moles, okay, for skin cancer early detection. And we put together an amazing opportunity analysis, which once we kind of uncovered it, from my perspective, was like, oh my God, this is so huge of an opportunity. And all we did was kind of mine Google for just some analysis of how many dermatologists are there out there, how many people are there, what's the disease prevalence out there, how many moles do people on average have, what's the importance of moles and the correlation with skin cancer. And you just put the math all together and you just got this, oh my God, there's one dermatologist to every 33,000 people in the United States alone. Everyone has like 10 to 50 moles, and it takes time to see your GP and then another 6 months often to get to a dermatologist. This is an enormous logistics problem. Like, this is just outrageous. How are you going to monitor your moles that have to be periodically inspected for overexposure to sun and the growing occurrence of skin cancer? But all it was to start was really putting these numbers together to go, this is such a huge opportunity if you can solve this problem. And so that's just an example of that, and it's really the starting point to, why would somebody want to invest in your business? Because if this opportunity, back to that 1 in 100, if this opportunity isn't like billions of dollars, back to the services question, it's unlikely that you're going to get a major VC financing. You might have a great idea, but it might be a smaller opportunity. There's nothing wrong with that. It's just the makeup of what the big VCs are kind of looking for is the magnitude of this opportunity. But you should really pay close attention and have good numbers around how you arrived at that opportunity analysis. The list of assumptions to everything here is critically important, because at the end of the day, it's like, tell me, this is all hypothetical. I need to understand your assumptions is key. And I'm going to talk about a cap table evaluation. Okay? So here's kind of carrying on with the financial modeling, but I think I had a conversation with somebody today, and I'll tell you, over the last few years in particular, really moving into operations, if you cannot build your business in Excel, good luck, honestly. And this occurs to anyone who's in operations as well. I'll tell you, you need to know your business model. You need to know what's happening all the time. And if something in your model is not happening the way you expected to, you better know it's happening and you better be able to react to it. Otherwise, you're missing the boat. So the easiest thing to do is start with a blank Excel spreadsheet and build your business. If you can't do that, then take some Excel lessons and build the foundation of your business, and then go execute on it, okay? Focus on revenues, okay? Who's going to buy? I think I get into it, but I'm just going to leave it for a sec here. And numbers become instrumental in telling the story. I'll tell you, you need to have numbers, and the best angels and the ones that you can really tell they've done it a lot are like, show me the numbers. We'll go pour through the numbers. We'll really want to know how you get to those numbers. And you can tell why they're successful, because that's what correlates to success at the end of the day, is your financial performance, okay? And believability, okay? That's your assumptions and how all of it adds up, and making sure that it's truly believable. Use your networks, get out and get them to challenge you and make sure that your numbers are solid. And in terms of costs, certainly this is more of a technical company startup, your real focus early on, because you're probably going to be losing money early on, but want to make sure that you're spending the money building the core technology and R&D, and ultimately moving into how are you building market awareness, marketing costs, and ultimately sales. Try to keep your general and administrative overhead costs as low as possible in your models. Okay? So this is kind of a little bit obvious, and my next slide I think I threw in is new, and I kind of talked to it a bit. This stuff is all relatively straightforward and obvious. I'll speak to these two. These last ones are really valuable in terms of how long does it take you to sell something? What's the cost of acquiring a customer? Again, QuickMobile's a good example where it was really fortuitous that you've got a business that sells software to events. Well, what's key about an event? It's on a date, okay? They got to make a decision. So it was really good because you had this point inflection where they had to make a decision. It was really valuable. Whereas if you're selling like an enterprise software solution or something that they don't have to make a decision on, it can hang out there forever. These acquisition costs really start to build up. The other one is just understanding your customer support costs. Are you really a services business? Are you having to provide so much service around your offering that, and it may not be a bad thing, but you just need to understand the importance of it. Ultimately, you want to wean your customers off of having a continuous support. That's by improving the software, how easy to use the software is, etc. Okay, this one I don't know who I talked to earlier, but they were like, oh yeah, we finished our business plan. But then he was like, but now we got to look at marketing and stuff. And a real business model, from my perspective, starts way, way, way back in and around opportunity. I switched leads and opportunities just to follow the Salesforce.com CRM model, which is, okay, who's going to buy your product and how are you going to go out and find a lead? Somebody who's like, oh, okay, I'm kind of interested in what you're doing. Your financial model should go all the way back to that point. They ultimately in Salesforce become an opportunity, okay? And this is the opportunity we talked about before, that $1 billion pie of the potential market for the business that the products, the services that you're selling. But how are you going to get the leads out there? How many are they going to add up? So it becomes what's called your pipeline, okay? All the potential leads that are out there become ultimately contracted work, or the work that goes into becomes your backlog, okay? So you've signed this work that ultimately will be delivered. This is really dependent upon the nature of the business, but this is kind of your traditional business. You're going to sell something, then ultimately you're going to deliver it. That's what's happening here. Then you've got to deliver it, and you've got to invoice it, okay? This is all starting to correlate into your financial model, okay? Hitting your balance sheet as a receivable. Where is it when it hits as a lead in your financial statements? Anyone know?
Maybe goodwill, maybe.
Nope, it's nowhere.
If you got bought.
Yeah, sure. But in your financial statements, it's nowhere here. It's nowhere there. It's nowhere here. It's nowhere here. It might be WIP here. That's why it's kind of like the financial statements are only a small part of the real financial model, which is How are we going all the way back? How are we going to get customers? How are we going to build a pipeline? How are we going to deal with the probability of closing that business? How are we going to build and manage a backlog of deliverable work? How are we going to manage the hiring to make sure we deliver the work on time? How do we get it invoiced properly so it finally hits our financial statements and starts showing, results? Okay, how are we going to collect it? And then this is kind of the end of the financial statements, right? We got 4 items here. That's your financial statements. But then this is where the value of your business starts kicking in here, okay? Were they satisfied? Are they going to come back? Are they going to churn? Okay? Do you know what your churn rates are? Do you know what your recurring revenues are? Okay? These are critical financial indicators, and ultimately what they add up to is a lifetime value of that relationship. Okay? It's quantifying this market opportunity and deriving what your lifetime value opportunity is out of that relationship. Proving that you can do it profitably results in however much your business is worth. Okay? So it's every single business process from a revenue perspective, finding the customer right through. You, from a financial modeling perspective, need to know all of this. It's not just the financial statements. It's a much bigger picture. And the reality, when you're in a sales position, like selling your business or talking valuation, you spend more time in and around this than maybe a short window or sliver of your financial performance here. Because this is indicative of what? What is this indicative of? Future. You're not going to buy you for your past, okay? This is future opportunity. It's validating your original opportunity. This is financial modeling here, okay?
So I assume you're going to go through this process numerous times as you get more intelligence about your business and so on. But if you're doing this at an early stage, so if you're talking really early and you're not necessarily operating, and therefore, how do you estimate things like that when you actually are not in business? So for example, the cost of supporting a customer, the churn rate, you could do some kind of survey research or survey your customers, but that would be an assumption, completely an assumption.
Yeah, you definitely could do that. I go to a little case study. I'll zoom into that, but the reality is you make it up to start. You think. You sit down with that Excel spreadsheet and you think about it, and how much time will it take? Who's got to be involved? And you really plot out every component of that process flow so that you really understand it. And then you hit the network and you talk to your network about it. Does this assumption make sense? Every one of those things that I put up there are associated with core assumptions to the success of your business. And if you don't know all of those, a good angel investor will poke holes in your business left, right, and center. Okay? If you know this and have produced a beautiful set of financial statements that any accountant could produce, they don't even really tend to go, other than showing you what I bet you every one of your sets of financial statements that are going on look exactly the same. Right? We didn't make any money year 1, we broke even year 2, and we're making a lot of money in year 3. It's like, okay, whoop-de-ding, but tell me the rest of this story so I can actually believe it. Okay? So that's where this modeling gets a little probably out of the realm of what you've seen or heard before. Kind of got to go do it to experience and then to fully understand it. Okay? All right? There's also, and certainly when I was in this was hot, which is I could describe as the eyeballs model, like Context Media. It was a company called Sumify. It was bought by Twitter. That was just an eyeballs model as far as I'm concerned. I think when we did the financial projections, it was like a 15-minute exercise, and it was like, look, there is some hot technology. If you do it well and get a lot of people seeing it and seeing the opportunity, and are open to, discussing that with the big boys, so to speak, there's some great opportunities, irrespective of what we just went through in terms of a long-term revenue model, okay? So this is definitely a reality out there today as well as a few years ago. But it's a little bit different perspective, and it depends on the nature of your business on how you're going to grow that. Ultimately, it needs to tie to revenue. I mean, I'm not a huge fan of these business models. I'm a little bit suspect of I shouldn't be, but of the Facebooks and the Twitters out there. I'm just kind of more of a traditionalist, but there's clearly a whole lot of value out there. So don't ignore it, and clearly there's just ways to kind of model it for just rapid growth and adoption. It's primary key indicators, right, of success. Okay. This is a little deep into kind of opportunity analysis, which is kind of, I've already talked extensively about. It's really just pairing up the written component of your financial business plan with the believability of your numbers and your opportunity, okay? I call it kind of the story to market take ratio. Okay, there's this opportunity, but tell me what you're going to do to really capture that. Who are your competitors? Why are you doing it better? Explain to me so that I can really understand that you really will get a chunk of that potential market opportunity. And so even though they're unrelated, they're absolutely integrated from the perspective of the story needs to tie to the numbers in a very close way. Okay? That's it. And kind of valuation. At the end of the day, you produce this cash flow, which if you go, what's the value of my business? And the reality is nobody really knows until you actually prove it. You could give it to a CBV professional business valuator, and they would just run a cash flow, and they would discount it at some rate associated with the risk profile of your business, and they derive a value. At the end of the day, it's kind of that's how it works, right? So, kind of moving on here a little bit, but because I speak to the valuation bit at the end. So here's a really QC docs. I would, if you want to get deep into this thing, at the end of the day, we had a paperless office solution so that we could just do accounting from anywhere. That allows me today, like I'm CFO for like 5 companies, 2 public companies, lots of startups. I have bookkeepers I never see. They work from home, all because of this software. Okay, so yeah, the original vision was to do something more like this, which was like, there's 3 million potential businesses out there that just have to do everything manually, and there's just shoeboxes everywhere. It's like if you could digitize this and get deployed out to all these accountants everywhere, isn't that a much better and more obvious solution? So this is what we did in terms of an opportunity analysis, and we just went to the U.S. Census, so you can get tons of data, as you might imagine, online, and analyze, okay, well, how many companies are in this space, and what accounting software are they using, or is it all paperless in this circumstance? And so we kind of formulated something that made a whole lot of sense to me. So this is just kind of an example of how you might go about building an opportunity analysis that would ultimately be believable if you could sell X number of software, X number of customers your software. Okay. Okay. This is back to when we were. So yeah, it was longer than 4 years ago. So yeah, here's just a typical kind of profit and loss statement of operations, and not much to talk about here other than this is probably what everyone else's statements at the end of the day will look like. Lose money in years 1, tie it or correlate it to customer growth, ultimately hit profitability, see inflection points in terms of when you're going to need financing, et cetera, et cetera. So I've done a whole lot of models since then, and I talked to Stephen later. We really need to kind of migrate to something much better, and there's some good examples, and ultimately we should get those out there. But here's at the end of the day what you probably will have something very similar to. Okay, this one I get lots of questions on, which is just your valuation and how this is kind of the step 1 with you incorporating the business on day 1, and it's worth like $600, and okay, well, how do we grow the value of this business? How do we manage raising money? How many shares do we create in our pool? Is it 100 shares on the day that you incorporate? Or is it 10 million shares or 100 million shares? And how do we manage this ownership interest? Is there reverse vesting? So if somebody leaves, how much gets clawed back without making this overly complicated? And so what this just simply models out is just your friends and family round, raise $100,000, then raise like $420,000 and hit certain milestones along the way that will see an inflection point of value. So it's kind of starting at like 25 cents, 35 cents, 50 cents. So this is a very typical cap table and how you would want to be modeling the growth and value of your business. It's got the concept of just pre-money value. So it's basically how many shares are outstanding times the offering price in your term sheet. How much money can you raise? On a post-money value is just this number times that. So on a pre-money value, it's the amount raised less that. So you'll be asked that, what's your pre-money value or your post-money value, etc. This is what they're referring to. Is there any questions on that? Super. In conclusion, yeah, just listen and learn. I think this program's fantastic. Angie does a great job over the years. Yeah, it's an opportunity to learn. Don't take anything personally when you get into pitches. Those are fun. It really, at the end of the day, I don't want to underestimate the importance of this little Excel spreadsheet exercise. It's like so fundamental to building your business. And then if you're an operations person, you should be watching this daily. So as you start to execute on your business and start seeing things change, you're going to either validate some of the assumptions you put together on day one or realize you made a big mistake. The great success of startups is you can move quickly to adjust. But I'll tell you, there's lots of people who just do this exercise and don't understand the need to revisit from an operations perspective and realize that things happen every day that they should be baking back into their models. And yeah, we don't like doing business planning, but I'll tell you, the companies that do this well and monitor, every one of the companies that exited, I know their CEOs were all over the Excel spreadsheets. They knew their businesses very well. They were smart business people, and not one of them was an accountant, but they all knew their numbers, and it's without a doubt a key ingredient to success.
Obviously, there's value in playing with other people's money, but from a financial point of view, if, assuming you believe in the models that you have, you could potentially, say, raise a loan rather than get money from a VC or an angel. So what's the trade-off between, say, raising financing in a traditional way and raising financing from a VC?
Sorry, I missed the first part of your question.
So,
what?
You know, the trade, if you, say, need, I don't know, say 100,000 to
Right.
get off the ground,
Yeah.
but afterwards you're going to start being self-sustaining after a
Yeah.
while. What's the trade-off between getting a loan for 100,000 from a bank, say, or from BDC or IRAP or whatever, and getting the 100,000 through an angel or a VC?
Yeah, I mean, if you're willing to take ideally, if you're that confident in your business that you can go out and do a debt financing, obviously you keep all of the value to yourself. At the end of the day, you just repay the debt and you own 100% of the business. It's kind of a little bit of a risk and growth profile, right? If you think you're a business that's going to need follow-on investment rounds to succeed, if the bigger vision is to, okay, we're going to execute on this and then we're going to do something bigger, which is very, very traditional. Yeah, you execute on this and you raise enough money. And you want relationships with angels and investors who can help either leverage into the next round of financing or fulfill the next round of financing. So that's more the situation where you need equity investors in your business. If it's just an exercise of needing $100,000 and there's very little uncertainty about either needing further financing, or having a business model that will require further financing, then yeah, you just go to the bank and you do it the good old-fashioned way.
But the bank won't lend you money on that.
Fair comment. So you need to have a business model or a succeeding business with enough proof of concept to get through due diligence with the bank. Okay, so which is there's a very, very valid question. Is like, yeah, they aren't going to. You just can't walk through the door probably with your New Ventures BC executive summary with having kind of done very little from a customer and revenue perspective and expect to do any sort of bank financing. That's it. I'll stick around if there's any other questions at the end. I'm happy to chat further.
You. So we'll take a 5-minute switch over. Thank you.
Okay, so just before I get started, just want to again help us to get to know each other a little bit better. So how many people here, well, first of all, how many people here, I know you asked the same question, but are in the process of starting a business? Put your hands way up. Oh, come on, you can put them up higher than that, can't you? Come on. Okay, good, just about everyone. Who here is going to be building a business where you're providing something that you can drop on your foot? Good. We need more businesses like that in Vancouver. Yeah, anything from clothing to hardware to stuff like that. And who here is building a pure software business? Great, so the majority. And how about a services business? Well, come on, don't be shy. Get up and wave, come on. If you're in services, you have to be able to sell the service, right? So, good, okay, and just to continue to get a feel, how many are in a business-to-consumer market? Okay, about what, roughly half, business to business? Okay, a third, say. How about business to government? I can barely see her, come on. Great, okay, so a few. The current buzzword, machine to machine. Anyone doing a machine to machine business? Oh, good, excellent. I look forward to hearing. Can you just describe quickly your machine to machine business? Because not everyone here will know the term.
So I'm building a smart herb garden for your living room, and basically the plan talks to the internet and a lot of Internet of Things and.
Okay. Not sure that's a pure machine-to-machine, but that's good. Okay. And anyone here building a two-sided market or platform business? So you're the brave ones. Good. Okay. Anyone here actually have an operating business? Oh, excellent. How many of you have revenues? Good. Okay. And how many people here are going to go out and look for investment? Okay, excellent. All right, so my name's Stephen Forth. I play a number of different hats. I have a number of different hats that I wear in the local community. I'm a partner at a local consulting firm called Rocket Builders. Rocket Builders is perhaps best known for the Ready to Rocket list. And that's a list in which I can assure you that you want to be on. Companies on the Ready to Rocket list, we actually did an analysis, and we have a much better success rate than any local VC in predicting future success. And we also have, and there's Ready to Rocket lists in information and computer technology, which I'm responsible for, in life sciences, which Thelsel Lee, who's also the director of eFund, is responsible for, and then in clean tech, which Dave Thomas manages. The focus of my own consulting practice is on pricing and innovation, and most of my customers are US software companies. So for example, right now I am helping a Los Angeles-based company that has about a 95% market share in a niche market figure out if it should move from a perpetual license to a subscription model. Which is a challenge a lot of people face. I'm also a hardcore serial entrepreneur. I can't stop myself. founded in Vancouver a company called Recombo, which is still operating down sort of over there, downtown. It manages business processes for onboarding at large financial institutions. Leverage Point is a company I started in Cambridge, Massachusetts. I spent a few years there working for a large strategy consulting firm, Monitor Deloitte. That was boring for me, so I bought part of the business and turned it into a software company. And then I found someone much smarter than me to run it so that I could come back to Vancouver. Fortunately, it's easy to find people that are smarter than me, so this has become my mode. As I get the business started, then I hire a real CEO so I can go on and do the next thing. And then I came back to Vancouver 2.5 years ago now. Tried just doing investing and consulting, but that really did not satisfy me. So about a year and a half ago, I started a new software company called NUG with my partner Amar Dhaliwal. Encourage all of you to go to nug.co and sign up for the beta. And we just filed our first app with the App Store today. And NUG is in the same stage as a lot of you. It's a pre-revenue company. We raised $350,000 last year, and we're raising more money this year. Raising money is like a drug. Once you start, you can't stop. I have done some investments directly, a total of about $2 million directly. But my wife thinks that I sign checks too easily. So she has insisted that from now on we're going to invest through angel groups. And right now I'm investing through eFund, and I'm usually leading at least one due diligence project at any one time. So we just recently made an investment in Optigo Networks, which is, I believe, a company that was in this competition last year. So it's hard to raise money. It is really hard to raise money, but it can be done. And I'm reasonably active on Twitter with the @StephenForth handle, right? So before we dive into business models, let's just do a quick reality check here. I'm sure all of you here are super excited about what you're doing. You've come up with the greatest thing since sliced bread, right? You got to believe that. If you don't believe that, why are you putting yourself through all this grief? Or actually, it's not actually grief for you. Why are you putting your significant other and your family through all this grief? To be more accurate. But let's take a quick look at sliced bread. Sliced bread was actually invented and patented in 1912, but didn't actually get to market until 1928. And there wasn't really any market adoption until 1930. Does anyone know what the problem was with sliced bread? Pardon? Slicing it. Nope, that was the easy part. That was what was invented in 1912. People have been slicing bread, of course, for 1,000 years. Yeah, it goes stale faster. It's a really stupid idea. It falls apart. How do you carry it home? They actually tried selling it with knitting needles stuck through it to hold it together. It wasn't until Wonder Bread figured out not only how to cut the bread automatically, but how to wrap the bread automatically, that they actually had a product that they could take to market. And that's true of most innovations. It takes usually around 20 years for a really true, new, deep innovation to get to market, and I don't really think that's changed much. So that's something to keep in mind. We all hear about how fast companies grow today, but there's often a long incubation period before they actually start, before a technology starts to really be commercialized. So, which is fine. That's not a bad thing. It's just the way that the world is. Can someone tell me what so we're here to talk about business models. We just had a session on financial modeling. What is a business model? Anyone want to sort of get up and give us a definition?
It's architecture.
Pardon?
The basic architecture of your business.
The what?
Architecture.
The architecture of your business. Okay. What's involved in the architecture of your business?
The reason.
Pardon?
The reason.
The reason you're having a business. Okay.
The reason we are
The vision, okay. All right, another definition?
It's the value transfer between different parts of your business and your customers and what you're selling.
Yeah.
I want to say.
Okay. I actually think that's so yes, it's how you're going to execute on your vision. I'm sorry, one more definition here.
A simplification of the processes involved in running your company that allow you to test your hypothesis.
Okay. Yeah, that's also true. I'm going to go back. I'm sorry, what was your name?
Dylan.
Dylan. I'm going to go back to Dylan's definition, though, because that's the one that's closest to the definition that I use. A business model begins with how you provide value to your customers. If you don't have a way to create and provide value to your customers, you don't have a business. This is where it starts. It doesn't start with new technology. It doesn't start with financial statements or financial planning or spreadsheets or anything else. It starts with how you're going to create value for your customers. Of course, it's not enough to create value. I'll talk a little bit about freemium business models later on. And I'm sure many of you have read Chris Anderson's book, Free, The Future of a Radical Price. But at the end of the day, money has to change hands. If it doesn't, you don't actually have a business. You might have a great nonprofit, but you don't have a business. And in today's world, I would actually add that there's a third dimension to your business model, and that's to invest. We live in a world where the pace and cycles of innovation are intense. And your business has to make enough money that it can invest in its own growth. I'm sure many of you here follow Amazon. So does Amazon have very high profits? Why not?
They do so much R&D.
Yeah, they invest heavily in their own business. You can argue that a company in a rapid growth phase that has very high profits is setting itself up to fail, or it doesn't actually know what to invest in, and it should probably give that money back to its shareholders in the form of dividends. So as you're designing and thinking about your business models, you have to think about, how do I create enough value that I can capture, that I can reinvest it? That's the full cycle. And if you don't get to that cycle, you haven't actually created a sustainable business. Lean Innovation, Lean Startup by Eric Ries and Steve Blanks, the Startup Owners, what is it? The Startup Owners Manual, thank you. Is that right? Anyway, something like that. There's a lot of new thinking about how we build these businesses, and the Steve Blank approach and the Eric Ries approach are actually quite powerful. That you start by building something, then you measure what you've built so that you can learn, so that you can have real facts, so that you can build something new, and that you want to get this cycle going quickly. But there's some fuzzy words here, right? Like, what does measure mean in this case? Who's following this approach? Okay, you've already spoken. So how about here, beside you? Yeah.
Well, measure means that you have a set of assumptions or hypotheses, and then you try to prove them, or you try to fail them, and then quickly go back and reiterate new hypotheses.
Yeah, absolutely. That's exactly right. So you're trying to find the data that you can use to prove or disprove your hypothesis. And companies that are good at this try to be able to cycle through this process in a small number of months, not a large number of months. If it's going to take you a year to go through one of these complete cycles, I'm almost sure that you're going to be out of business. So there's a guy back in Korea, a guy called Jeff Boyd, who was a fighter pilot who developed something called OODA loops. I encourage you all to look this up. OODA, OODA loops. OODA is observe, orient, decide, act. And what Jeff Boyd figured, and Jeff Boyd, his nickname was 22nd Boyd, because that's 20 seconds was how long it usually took him to shoot down the opposing plane. If you can get inside your competitor's OODA loops and can do this process of observe, orient, decide, act, build, measure, learn, get the facts, and build again, you're far more likely to win. But this is not the goal, right? The goal is not to build these rapidly cycling companies that are spinning through cash and going around in circles. If it were, my 2-year-old granddaughter would be a great startup CEO. Her favorite phrase is "run in circles." Yeah, run in circles, Gigi, run in circles. And then she also likes when you go to a fork in the road, she goes, "Let's go find out." So, yeah, I mean, so she's a perfect startup CEO, right? She's getting ready to raise money, though, because recently she started to go up to people and say, "Dance with me." So which is fine for a 2-year-old. But eventually, we want to get our companies to a place where the minimum viable product evolves to become the product that is actually demanded by the market, including a viable revenue model. And even that is not enough for a truly sustainable company. You have to have an addressable market where there's a growth engine or a very, very clearly defined niche. And all of these things have to become aligned. Hootsuite is a super successful company in Vancouver, I think most of us would say. Why is it so successful? What's driving Hootsuite's growth?
Well, it was first Twitter, and then the rise of social media as a whole worldwide.
Yeah. So when they started Hootsuite, I think there were about 5 million users on Twitter. I think there's what now, 250 million? Is that right? Something like that. So they're, that's been the engine of growth that has driven Hootsuite's growth. So if you are lucky enough, and the guys at Hootsuite have done a fantastic job. They've executed very well. They've had a lot of courage not to sell, but they were also lucky. Luck is a very good thing. May we all be lucky. But this is one of the things that you want to be looking for, right? What are the powerful long-term trends that are going to become your engine of growth? If you can understand those, and understand those better than anyone else, you'll have a very compelling case to make to investors, and your hypotheses and assumptions are going to be more likely to play out. I'm going to skip this. Steve Blank has a lot of great videos up. And this slide deck gets shared with everyone, right? Yeah, so you can click through the links in the slide. So to me, there's sort of 3 dimensions to a business model. You have to be able to say it. If you can't say what your business model is, you've got a real problem. This is sort of your 30-second or your short pitch. I personally hate the whole concept of pitches. I think it's a total waste of time. I only pitch when I'm absolutely forced to. And I usually only pitch because I want to go to an event where I want to meet people and have conversations with them. But you got to be able to start a conversation. And your quick verbal explanation of your business model is that hook. Or maybe the bait on the hook. But anyway, it's what you use to get the people that you want to have conversations with to start talking to you.
Can you give us an example or two?
Sure. What I would prefer to do, though, is anyone here who knows Nug's pitch? Now, see, this is what you should do, by the way. You should always try to see if someone else can pitch your company for you. I don't see anyone in this room, though. That shows that I'm doing a terrible job, because there should always be someone in the room who can pitch for you. So I'm going to pitch, give you the hook for Nug. So right now, the world has turned into a place where companies are teams of teams. They're not hierarchies or matrices, and they're not social networks. Teams are where work gets done. We've got a lot of great apps coming into the market now, like Slack and HipChat, that pull all of that communication together into one place. The result, though, is just more noise. What Nug does is it gets your teams focused on the critical questions that they need to succeed, and it tracks the decisions and then connects those decisions back to the goals. So how many people here are working on a team? Good. All of you are going to be using NUG. I don't know if that's any good or not, but that's NUGs. But the critical thing, though, is not if you can give it, is if you've got your message out into the world around so that other people can give it. That's the test. So whenever you can, and it takes a little bit of nerve, right? Like I was at the Canadian Financing Forum, and I was there with, I forget who was standing, it was Frank Lafleur or someone like that was standing beside me, and this VC I've got a lot of respect to comes up and says, "So Stephen, I hear you're doing this new thing, NUG. What does NUG do?" I say, "Oh, Frank, can you tell him?" Frank. But he does, and he actually did a pretty good job. So, so it's a risk. But hey, if we didn't like risk, we wouldn't be doing this stuff anyway, right? So that's actually the critical thing about this verbal pitch, is you got to get it down so that other people can give it for you. And that's the test. You're also going to need to be able to draw it, though. And I don't mean draw it on your business model, can't have a nice, glorious business model canvas or an elegantly illustrated PowerPoint that some graphic designer has done for you. I mean, get up on a whiteboard and draw it. And the reason that you need both the verbal and the visual is that the human mind is most powerful when it can synthesize two different modes. So you have to be able to do both. Everyone here should be comfortable walking up to a whiteboard and say, "I'm going to draw my business model for you. Try it when you get home tonight." And then the third thing is, you got to get it into a spreadsheet. As we were talking about earlier, if you can't put it into a spreadsheet, you don't actually know it. The other thing to think about business models is that a lot of us spend most of our time innovating on our technology and then on our product, and we don't spend time innovating on our business model. We are now in the golden age of business model innovation, and I'm going to suggest that there is more shareholder value to be created through business model innovation than there is through pure product or technology innovation. So why are there so many different types of business models? Does everyone remember those little books you had when you were a kid, those flip books where you had the top part of the body and the middle and the bottom, and you could flip back and forth and put different bodies together through the flip books? That's the kind of world we're living in now. There's a lot of innovation you can do on market structure, whether you're in B2B or B2C or M to M or M to C, or pick your random combination of letters and numbers and stick them together, and somebody is building a business model on that. There are lots of different ways of going to market. The two big, the most important change, I think, over the last decade is the change in the way that people buy. Today, most companies are about 70% of their way through their buying process before they ever talk to you. This is a fundamental change in how business works. And it's great for early stage companies because it's really lowered the cost of going out and getting that initial set of customers, that initial validation. There's also lots of different delivery models. Everyone here knows Cisco, right? Would you say Cisco is a hardware company or a software company? Yeah, so we've got support, hardware, and software. What it primarily is, though, is a software company. But it has many different ways of extracting value from its software. If you actually parse Cisco's R&D expenses, over 90% is on software. But if you look at their revenues, it's less, I think it's around 30% is software today. Has anyone looked at their latest numbers? I think that's rough order of magnitude, right? Or another company, does everyone here know a company called SAS? So it's a hugely successful company, right? So SAS has created more wealth for its employees, who also happen to be its shareholders, than any other company. Google has created more wealth for its shareholders and some of its employees, but SAS has created more wealth for its employees. And it's done that because although it's primarily a software company, it sells that software as a professional service in most cases. So, the other thing I hope you take away from this evening is that innovation is not just about technology and product. In today's world, innovating on business model is every bit as important. So some of you here are in two-sided markets. I'm just going to say a couple of brief words about two-sided markets because they're so important. The standard example of a two-sided market, everyone has one in their pocket, is a credit card. This is the most common example of a two-sided market because you have, on one side, you have consumers, people like us, and on the other side you have the merchants, and in the middle you have a platform. Sometimes these are referred to as platform businesses that can take money from either side. And you have, these days, sometimes you have three-sided markets. And God knows, I'm sure there are five-sided markets out there. I would not want to be the person who has to manage the company, though. Two reasons to think about two-sided markets, even if you're not in one. First question to ask is there any way somebody could compete with me by creating a two-sided market? You need to know the answer to that question. And if the answer to that question is yes, then you need to look really hard about at which side of the market they're going to monetize. And if they're not going to monetize the side of the market where they compete with you, you're dead. There is no way for a conventional business to compete against the wrong side of a two-sided market. And you know what? That sounds harsh, but it's good to know if you're dead early. Otherwise, you'll end up looking like the newspapers, which believe me, you don't want to. So I said a little earlier, people should be able to draw their business model. Tomorrow's Friday, right? Tomorrow's Thursday. Damn it. Well, I'm going to pretend it's Friday anyway. So next time you're having your all-hands meeting, take a bunch of crayons, and I think it's important to use crayons, wax crayons, like kids use, and some big sheets of paper, not little bitty 8.5 by 11, but some nice big sheets of paper. Give a sheet of paper and a bunch of crayons to everyone, send them out, each person to their own corner, give them a little bit of quiet time, and have them draw the business model of your company. You will be absolutely shocked and astounded, in some cases dismayed, and in many cases delighted by the results, and you will learn something that will probably change how you think about your business. I first learned this technique actually from a very good engineer who does this with his engineering teams. About every 3 months, he sends everyone into a corner and says, draw the architecture. We learned so much from that. I started doing it with the entire business team as well. I said, draw a technical architecture. If nothing else, it gave the engineers something to laugh about. Now, I don't do that anymore because engineers laugh at us enough, business people enough anyway. You don't need to encourage them. So it's even more fun to get the engineers to draw the business model. How many people here are using the business model canvas? Yeah, it's a great tool. You will be expected to have a business model canvas by most investors. And this is a very rapid change. It's a change, I'd say, over the last 6 to 12 months. And partly because of Steve Blank and what we're going to look at next, you will need to have a business model canvas. How often do you update? So who has a business model canvas? Put up your hands again. Good. Who's someone you haven't picked on? How often do you update it?
Every 2 or 3 weeks.
Excellent. That's what you need to do. It's not a static document. It has to be a living, changing document. And so why are investors going to ask for this? Oh, okay, I'm sorry, I do the spreadsheet stuff first. So you need, I think we covered off the spreadsheet stuff pretty well, but you need to have a spreadsheet, and it's so important that you have to be able to build it yourself. It is not technically difficult to build these things in Excel. But you need to build it because you need to be able to deeply understand it. Now, if you can't understand the spreadsheet that models your business, you can't think about your business in an actionable way. And I think you covered almost all of this, right? But when I look for spreadsheets now, I want people to start not with market size, because I don't believe, it's not that I don't believe, I don't care what anyone says about the gross size of the market. I want to start with the funnel assumptions. How are you going to get awareness? And what I really care about is awareness of, I tend to be in B2B, so awareness of pain and awareness of solution. Because if you can get awareness of pain and awareness of solution together in the same head at the same time, you probably get consideration. And then from consideration, you can convert your leads into opportunities and so on. So I like to see business models that lay all of this stuff out with all of the assumptions. Now, and we'll talk about pirate metrics a little bit later on. Now, why do investors want people to build business models?
Shows you have an understanding of what you're doing.
That's one critical reason, yeah. Do the investors think the business model is right?
Never.
Of course not. If I thought you could come to me with an accurate business model that predicted your revenue 3 years from now, I would invest, I would just give you all of my money and tell you to go and invest it. But on the other hand, you wouldn't actually need to, because if you actually had that ability to predict the future, you'd have far more money than you knew what to do with anyway. So we're really looking for just two things, right? We're looking for the ability to think through a business, and second, it's the assumptions that can test the hypotheses, so that you know what hypotheses to test. So I'm going to skip through this because I think it was already covered quite well. But I will tell you that, so I do due diligence on investments. I absolutely require a business model with month-to-month projections and data for every month that the company has been operating. If you don't have that, I tell you to go away and come back when you have it. And preferably since the very beginning, but if you're just starting, then I need at least 3 and probably 6 months of data. So the moral of the story is start now. If you don't already have this, start now. And it's not just one person at a company that needs to grok, to sort of deeply understand these models. Everyone in the company should get it. The engineers, the customer-facing people, the financial people, everyone should understand the assumptions in the business model, because otherwise they can't align themselves and make the decisions that you need them to make in any sort of effective manner. We are experimenting with using something called the investment readiness level by Steve Blank. This is based on, it's a sort of a mashup of NASA's approach to evaluating when new technologies are ready to adopt and the business model canvas. And it's a really good way to test. Has anyone seen this before? There's really good blog posts about this online. There's a link. The investment readiness level by Steve Blank. If you Google that, you'll find it quickly. But it's really about complete your first pass through the canvas. Look at the market size competitive analysis. Test your problem solution validation. Prototype a low fidelity minimum viable product. Validate product market fit. Validate the right side of your canvas. That's all of your customer-related stuff and your revenue-related stuff. Get a high-fidelity minimum viable product. Validate the left side of the canvas, and then really start tuning up your metrics. So as investors, we tend, every investor is different. But it is almost impossible in Vancouver today to get investment unless you are at least at level 3. There are precious few people that will invest in the back of the napkin drawing anymore. I don't think there ever were any, but they're certainly scarce as hen's teeth. So you have to be able to figure out how to get at least problem solution validation and probably have some initial level of minimum viable product before you're actually going to be able to attract any meaningful amount of investment. So one of the things that we do when we're workshopping this is we actually break people into pairs and we have them evaluate each other's company. And we actually had a company, we were doing this in Halifax earlier this year, and we actually had a company that was at level 9. And not surprisingly, they just raised $20 million. But those companies, again, it takes a lot of time, effort, and thought to get that far up. What we're trying to get to in all cases, even if you're a services business, is a scalable business model. And there's some people who think these metrics, LTV and long-term value of a customer acquisition cost, and so on, are only relevant to B2C companies, but that's wrong. I now apply these metrics to every kind of company I look at. So you need to be able to speak intelligently about these and have a plan, first of all, to be able to calculate them, and second of all, to improve them. What I'm actually getting companies to do now is actually to draw these up on a wall and sort of on the whiteboard and draw all the factors that determine these. And I've got a slide a little bit later on where we look a little bit at the math behind them. But if you go to David Skoke's blog, do you know the name of the post? SaaS Metrics 2.0. So if you Google David Skoke, SaaS Metrics 2.0, there's an excellent article on this. The point I'd like to make is that they're not just for software companies. This applies to every kind of company today. It actually came primarily out of telecom, is where these models came from. And I get rid of that little thing. Gotta love Microsoft. The really important thing to know is that in order to have a viable software business, the ratio of the long-term value of your customers to the customer acquisition cost needs to be higher than 3. If it's lower than 3, and you are in any way a mature software company, the VCs will take you out and put you, and shoot you. I was surprised when I first heard about this stuff about 8 or 9 years ago. I was at some sort of investment conference, I think, and the guy who was running Intel's VC fund came up to me and we were talking about my business. And he said, "So what's the ratio of your long-term customer value to your CAC?" What? He says, "Oh, because if it's less than 3, you should just shut it down and go on and do the next thing." I had no idea what he was talking about. Yeah.
The long-term value calculation, which you quickly run through.
I've got a slide on that later on, so I'll try and pick up the pace to make sure I get to it. And I have my own approach to this. I would also say that the details of how you calculate this are going to be unique to your business. So there's you don't want cookie cutter approaches here. You want to have it based on how you understand your business. Okay.
So when you address this long-term value and CAC early in the company's life stage, long-term value is low and CAC is high.
Yeah.
When you grow, the opposite changes, and
hopefully.
So the ratio, hopefully, yes. But is there a rule for the early stage of the company? I mean, do you have to be greater than 3 to start with?
No, you don't have to be. Great question. So everyone heard it? Do you at the very beginning, do you have to be? Does this ratio have to be greater than 3? No. It doesn't, but you must be able to tell a credible story about why it's going to change. If you have 0 customers, then this ratio is going to be 0. So, but you have to be able. So this is your business model has to be able to bring out and bring forward these 2 numbers. So I would actually like to see, in some row in your business plan, the ratio of LTV to CAC. I almost never, I haven't seen that in any Vancouver company yet, I don't think. That's not, My Best Helper actually has it in its most recent business plan, but that's because I told them I wouldn't invest if they didn't put it in. And then we had some guy in the DD committee who hated My Best Helper and we didn't invest anyway, but I would have written a check. This is the problem when you're dealing with committees to make investment decisions. I think my wife would say this is the benefit of dealing with a committee to make investment decisions. Everybody here know the technology adoption cycle by Jeffrey Moore? Okay, so this is that's great. I see most people are nodding their heads. This is absolutely critical stuff to understand. What you need to understand here is why people buy in each of these cycles. So innovators are people who use new products and technology because it's cool. That's the only reason. If it's hard to use, that's probably a good thing. If not many people use it, that's also a good thing. They want to use it because I have this latest broken, half-built piece of technology, so I'm clearly smarter than you are. Innovators are, so they're an important part of the ecology. It's really important to know them and to build relationships with them, but they're never going to give you any money. What they will do, if you've been good at building relationships, is introduce you to early adopters. Early adopters tend to travel with innovators, and sometimes it's hard to tell the difference, but an early adopter is buying a new technology or product or service because his competitors do not have it. That's critical. They're buying because their competitors do not have it, and they're buying in order to get a competitive advantage. The reason that there's this Jeffrey Moore style chasm is because these guys over here, they only buy because other people are buying. And even worse, in most cases, they won't buy because an early adopter is buying. Everyone in the industry knows who the early adopters are. BC Hydro is actually regarded as an early adopter in many parts of the energy industry. Hard for us to believe, right? But apparently it's true. I've been told this by people in New York and Tokyo, that they actually look to BC Hydro to see what technologies it's adopting. Analysts say that the other people in the industry tend to think the early adopters are crazy. Joe, he always buys the next new thing that comes along. Of course, he's probably far more successful than they are too, but anyway. The bowling alley, we're not going to talk about market entry strategy here, but it's important that you know all of these things and that you can couch your business plan in these terms. So if someone comes to me and says, I've got this new innovation and I'm taking it to the early majority, you go, huh? What does that mean? That doesn't make any sense. So you have to be able to use this language. And if you come and say, I'm going to sell to the innovators and I'm going to make lots of money, go, no, you're not. You're not going to make any money. Or if someone comes and says, I've sold to an early adopter and they validated my price. No, they haven't. Early adopters do not validate your price because they're willing to pay more in order to get competitive advantage. I'm sure you all know also the sustaining versus disruptive innovation model from Clay Christensen. Again, it's a critical model to understand as you think through and articulate your business plan. And the critical thing here is that users' needs do not go up as fast as product and technologies do. So every mature technology overshoots the user's needs. And in the process of doing that, it opens space for a lower cost, lower function disruptive technology. This is really important here. There's a subtle thing going on here, right? A disruptive technology usually is not as good as the existing technology on most dimensions. Because often when we're building these new technologies, we talk about how much better it is. Right? If it really is that much better, it's probably actually not disruptive. It's probably a sustaining innovation. And you know what? There's nothing wrong with sustaining innovations. I would guess that 95% of new companies are built on sustaining innovations. Disruptive innovations are much rarer and much more difficult to do. But if you can do them, then you get these unicorns, these $1 billion, $2 billion, $10 billion companies. But it's important to be honest to yourself and with potential investors and your partners and the people in your company about what you're trying to do. Are you trying to create a sustaining innovation or a disruptive innovation? Yeah.
Just looking at the relationship between enterprise and a smaller business, and I was thinking that perhaps the enterprise market, because they're better funded, would typically be the blue line, which is the innovation, and that small business would typically pick up the disruptive technology. Would that be a good assumption?
Sometimes this would actually be the large businesses. This green line and this lower green line would be the small businesses in your model. But what you're saying is accurate, that it is in many cases easier to bring disruptive innovation into smaller businesses. Not always, but in many cases that's true. But let's face it, most of us do not have disruptive innovations. So as you're thinking about your business, this is the approach I'd really like to see people start thinking through. What we normally do is we build a product, and we figure out how much that product is going to cost to service in the market. Based on that cost, we come up with a price. Hopefully, we can find someone to buy it at that price. And maybe, who knows, the customer gets some value from it. Unfortunately, this describes most companies. But the best practice, and this is actually why so many companies fail, because this is the approach they take. If you can flip this around, though, so that you start with your customer, you start by really understanding your customers and how you can bring them value. And then build the product that actually delivers that value. Understanding how much value you actually provide, you set your price. Given the price that you can charge based on the value you provide, then you figure out how much cost you can afford. It's a very different process from what most of us follow. And I have to admit, my first few companies, I definitely took the topmost approach. And it wasn't until Leverage Point that I actually started to try to do this. Yep.
Would that mean giving away your product for free for a specific period of time while you learn what the price would be?
It can sometimes, although not normally.
So you still charge, but it may not be. It may be a fraction of what you know.
Not necessarily. We'll come to that because remember, in all likelihood, So let's go back. Actually, no, I think I'm actually going to come to where I talk about that. So I've actually got a slide that talks about that a little bit. So I'll just right now just say not necessarily. So I've been talking a lot about value here. And value is one of those fuzzy, nebulous words, right? That can mean anything to anyone. I'm using it though in a fairly specific way. So value, it's for the customer. It has absolutely nothing to do with your costs, or how cool you think you are, or how fancy your technology is, or how many patents you have, or any of that stuff. Your value is only understandable from the perspective of your customer, and it's always relative to an alternative. And people, everyone, you don't hear this. I think things like New Ventures BC have coached people well. You seldom now hear people come and say to you, "Oh, I have no competition." I think we've managed to educate people that that's a dumb thing to say, because the fact is that people always have an alternative, right? They can do nothing. They can continue to do what they do today. If your product is new, the world has managed to somehow survive up to now without it. And you know what? If you don't sell it and your business fails, I don't think the world's going to disappear. So there's always an alternative. And you need to be able to be articulate and to understand what that alternative is. And then there's two dimensions to value. There's economic, which in fact can always be quantified in dollars. Maybe an estimate, but it's quantifiable. And then there's emotional value. In general, economic value is more important than B2B, although emotional value is not irrelevant. And in general, emotional value is more important in B2C, but it really depends. But there are cases where economic value becomes very important. There's actually a formal way of modeling all this stuff called economic value estimation. It was developed by a fellow called Tom Nagel, who is now retired and lives in Miami, where at the age of 67 he's training for, I think, his fifth amateur boxing match. He was complaining, he said, there's no hills in Miami. It's hard for me to get my cardio, so he runs back and forth over that bridge. The guy's freaking 67. He's running back and forth over that bridge in the heat. Anyway, when you're doing this value modeling, you start with the price of your next best competitive alternative. Again, this is a reason why you have to know what the alternative is. And this next best is important. You don't pick the crappy alternative. You really have to be honest and pick the next best alternative. There's four basic ways in which you can deliver economic value to your customers. You can help them earn more money. You can lower their operating costs. You can lower their working capital requirements, or you can lower their capital investment requirements. There's actually two more, but you can reduce risk and you can provide optionality. I don't include those because they're very hard to actually sell unless you're selling into an insurance or a financial market. And then you have to be honest with yourself, because in the real world, this competitive alternative is going to do some stuff it's going to do better than you. So you have to subtract that out. And then you may have unique costs. Maybe there's training costs, or you use some special input. Or if you're Hootsuite, you have to hire this new social media marketing manager. Where are you going to find them? So there's always some negative value drivers. I've probably looked at 3,000 or more of these models over the last, it's getting closer to a decade now. And one of my quick tests is, are there any negative value drivers? If the answer is no, then I say, you know what? I don't believe you. I don't believe that you are every bit as good as the alternative and that you have no additional costs. Now, sometimes you do this stuff and you find out that actually you're less valuable than the competitive alternative. Is that the end of the world? No, not at all. As a matter of fact, if you're a disruptive innovation, that's probably the case. It does, though, tell you something about where you can price. Because normally you're going to price somewhere in this range. And if those red ones are, go way down here, then you're going to be pricing again below that.
And how about the product is discontinued?
Sorry, the product is
discontinued.
Yeah, I understand this. I'm not sure I understand the question, though.
That means that if the product no more support or no more coming out, discontinued product.
Yeah. Oh, so your competitive, you mean the competitor is discontinued?
Manufacturer.
Yeah, but who? Your product or your competitors?
The manufacturer, no more in the market.
Yeah, but are you the manufacturer or so who are you asking about?
I mean that you have the product.
You have the product is coming to be no more in the market. We had to phase out the product.
Okay, so you're talking about a product that's being phased out of the market?
Mm-hmm.
And what's your question? So how you phase it out, or what does that do to prices? Or I'm not sure I understand the question.
At the end, we had to get the money back from the customer.
Oh, because you had to give the money back? Or
yeah, to get the money back from the customer in order to get the cash flow.
Okay, so your cash flow problems are not your customer's problem. Now, if your business does not create enough value to get a price that covers your costs, that's your problem. It's not your customer's problem.
But in the market, we had to push all we have in the market, no matter the product is valuable or not. But you come to the customer side to buy that. So what shall we do?
So I'm still not sure I fully understand your question, but the way that you use this, I haven't actually talked yet about how you would use this in sales situations.
Yeah, that's right.
But I'll give you. How are we doing for time?
We're just about hitting 9, so I'm going to, if it's okay with you, take an extra 15 minutes.
Yeah, and I'll answer your question then offline, because I can give you some concrete examples, but they take us off in a different direction.
So if anyone needs to go, the back door is open. Just feel free to quietly leave. Otherwise, we'll go another 10, 15 minutes.
Yeah,
okay.
I'll try and pick it up. So there are ways to get to the economic value, but the economic value does not answer everything about value in markets. So Maslow's hierarchy of human needs is actually a really powerful way to understand the emotional value. And what you're trying to do here in most cases is to position what you're selling to serve higher level needs. Who does this in Vancouver? Yeah, Lululemon has done a brilliant job of doing this. Everyone's seen their bags, right, that have their manifesto on them? Those are about self-actualization. Now, that's a B2C example. The fact is, though, is that you can actually use this in B2B sales as well. So when I'm selling B2B, I always make sure that I try to know two things about the person I'm talking to. I try to know what their CEO has said about their company's goals this year, and I try to know what that person's key performance indicators are. And I try to position whatever I'm selling to say, this will actually help your company achieve the goals that your CEO... See right here, this piece of text? We help you do that. And this is actually a way to leverage emotional considerations in B2B. And when you can do that, you can almost always realize a higher price. So I'm just going to go through this stuff a little bit quickly. Most innovations, as we said, are sustaining. And in sustaining innovations, the value drivers are already understood by the market. So all you're doing is tweaking them. You're making them you're going to help them get a little bit more revenue, or decrease a little bit of their costs, or make their plant a little bit more efficient so that they don't actually have to build a new plant. That can be quite a big deal. And pricing structures are pretty much entrenched. Disruptive innovation, though, it's almost the definition of disruptive innovation. There are new value drivers that nobody else is able to deliver. This is another way of telling whether your innovation is actually disruptive or sustaining. Let's quickly a little bit on the experience of technology adoption and pricing. Remember, these people here, the innovators, they tend not to pay. So I'll give you a concrete example from my last company, Leverage Point. So we actually built software that did B2B pricing. And we went out and went to the McKinseys and the Bains and the BCGs, and they said, oh, that's freaking brilliant. We love it. It's absolutely great. Yeah, we would love to use it. So we built it. We built a first version and said, okay, great. Well, so here it is, and here's how you use it. And they say, great, yeah, we can hardly wait to use it with our clients. We said, good, so it's going to cost you this much. And they go, what? You want us to pay for it? We're McKinsey. We don't pay for stuff from little software companies. Oh, God, we're screwed. So then we fortunately found an early adopter, W.R. Grace, a specialty chemical companies. And we talked to the CMO there, and she said, you implement value-based pricing? That's fantastic. How much do you need to build it? $600,000? Good, here's the check. Wow. If she'll pay $600,000 and we haven't even built it, how much is the rest of the market going to pay when we get it out? When we get into these early adopters, and Leverage Point now has very large market share in specialty chemicals, so we actually know how much the market's going to pay. Anyone want to take a guess what our ASP is in the specialty chemical segment if our first customer paid $600,000? So 2 million, 50,000?
60,000.
60,000? Yeah, that's actually 102. So we didn't make anywhere near as much money as we thought. We actually thought, we never thought we were actually going to get 600, but we thought we'd get more like 400. Ended up with 102. Just very quickly, another key concept for you guys to think about is your value metric. So when you're talking about your business plan, almost all of you will have some form of pricing metric. But what I'm looking for now is your value metric. And your value metric is what's the unit in which your product is consumed that ties to how your customer gets value. So in the case of paint, we buy paint in cans. That's the pricing metric, right? $40 a liter. But the value metric is actually how many square meters that can of paint will cover. And understanding the relationship between your pricing metric and your value metric is really going to help you come up with an innovative business model that will work. So I'm going to end on here with just another little story about how someone made this work. So a friend of mine was runs a building materials company, and they invented and developed a new sealant for concrete floors. Where one drum could cover about 6 times as much as a conventional drum. So do you think they could get 6 times as much money for it? Of course not, right? You go to a contractor knows how much a drum costs. Maybe he'll give you another extra 5%. But there is absolutely no way he's going to pay 4 times or 6 times as much for a drum because he knows what a drum costs. If that was your business, what would you do? Okay. Well, pardon?
Smaller cans.
Smaller cans. What he did sell it by the square foot. What's the challenge in doing that, though?
It's not comparable easily.
Contractors don't think that way, right? They don't. That's just not how they've grown up to think. Who does think that way?
Homeowners.
Not so much the owners, and the owners actually. This is more for the new buildings anyway, because it's architects and their consulting engineers and specifiers. So he built an entirely new sales team that only targeted architects and specifiers. He was able to get about a 200% premium compared to his competitors, and he got his market share from 7% to almost 27% by being able to understand what the value metric was and finding a better way to tie the value metric and pricing metric together. And that is the key to a super successful business model, is being able to connect value and pricing in a compelling way for your customer. Okay, sorry, I went a little bit over. I could talk about this stuff for hours, but rather than talk about it, I'd rather have conversations. Yes, one more question.
Housekeeping, could we just quickly do that?
Oh yes, I'm sorry. Yeah, I have way too much content, right? Okay. So this is the standard way to calculate LTV is your average selling price. This is assuming a subscription model, times the number of months you're going to be able to continue to sell it, times the percent churn, and then this next point is really important, minus the cost to serve. Sometimes this is referred to as net LTV. But this is the number that matters. If your cost to serve is high, like it is in a professional services business, you have to subtract that out. So this customer I have this client I have in the States right now, right? So I actually calculated their LTV of their perpetual licensed software, and it's pretty easy, right? It is their average selling price that comes to them times the number of people that actually buy their upgrades. Because they don't have any cost to serve, because they're giving you stuff that you install in your computer. They actually have a small cost to serve in terms of their support center, but it's less than 1% of their of their revenues.
What if you're doing business-to-business software? How do you estimate the number of months if you sort of expect it to be an ongoing, indefinite thing?
Yeah, if you assume more than 36 months, you better have a really good reason to explain it to me. And in software, it's really hard to justify more than 36 months. You might get away with 60 months if you can show precedent. And it doesn't just have to be you, right? If you can show that other suppliers in the industry generally can predict their renewal rate 5 years out, you could probably convince me to accept an LTV based on that.
Same for B2C?
Yes, although your churn is probably much higher. Not always, but usually.
Hold on. We have to do the microphone now.
How do you apply that to a physical product?
Same way. So let's say I'm selling a valve. So I have a valve that I sell. Do I have any additional services that I wrap and sell with it? Maybe I sell a maintenance contract with it. What are the chances that they are going to have to buy a replacement valve, and at what price? So I can calculate all of that out, and then but then I have to subtract out the cost of goods. So Parker Hannifin, I don't know if people here know Parker Hannifin, but it's a $16 billion American hydraulics valve and filter maker. They're actually, in the filters that they're coming out with a set of filters next year that will be filters as a service. They've actually instrumented the filter, and you will only pay for the throughput and the purity of the throughput. So a lot of even filters for petrochemical plants are actually moving to a subscription model.
Could you spend 1 minute on pirate metrics?
On the power of metrics?
Yeah, and then do you actually provide consultancy on those issues?
So the answer to the second question is yes, but I'm highly selective. So I only provide services to people I really think I can help, because I'm not actually looking for work. So the power of metrics, so metrics are critical. There's actually a movement afoot in Vancouver to get people to be much more public about their metrics. You should always be tracking at least one critical metric to your business. You should be tracking it at the very minimum every week. And you should be reporting it to all of your stakeholders. And the metric that will matter to you will depend a lot on the stage of your business and what you're trying to optimize. So, for example, everyone knows that company in Montreal, Off the Rack, I think it's called, the Beyond the Rack. Thank you, Beyond the Rack. They had a period where the metric that they were trying to optimize was how many orders got shipped in one shipment, because that actually had a big impact on their profitability. So I think the critical thing around metrics is that your metrics are going to be like your fingerprint. They're going to be unique to your business, and they're going to change as you take your business through different phases. So one of the things that I always ask people now, both when I'm looking at investing, but also as part of the Ready to Rocket program, is what metric are you trying to optimize? Then after they answer that, I said, good. Once you've optimized that, what's the next metric you're going to try to optimize? You should probably be able to answer that question at least 3 metrics out. You may change your mind. And you may, as you're optimizing one, you may find out that, my God, I can't optimize the freaking thing and my business model falls apart. But you should always be that focused and that articulate about the metrics. And I don't think that there is one metric, there's not a common metric for each stage. If you start giving me vanilla metrics, it just tells me that you haven't thought hard about your business.